The M&A landscape has been tough this year, hit by rising interest rates and ever-present fears of a looming recession, but there are signs of recovery now. We saw 2 mega mergers in the energy sector in October, remember, from Chevron and Exxon, and our next guest is seeing some bright spots in 2024. For more, we turn to Marc Cooper. He's CEO of Solomon Partners. Marc, thank you so much for joining us. So, listen, as we highlight there, M&A, there's some challenges, rates, geopolitics. There are certainly some still worried about the economy. How does the M&A environment look to you right now, Marc, and what do you see as we move here into 2024?
Well, thanks for having me. It's maybe what I'm hoping for, and we're certainly hoping for a better market because, as you pointed out in your opening, it hasn't been so great over the past couple of years, and this year again down, I guess, year-to-date 20% versus last year, and last year was down from the year before, although 2020 is not a good indicative year. But if you go back to, say, the first clean year, 2019, we're probably down close enough to 40%. Yeah, there have been some big transactions. They've been a bit idiosyncratic, not necessarily, in my view, the harbinger of continued or growing activity, but having to do with a lot what is going on within their industries. Having said that, though, I am cautiously optimistic that things will open up next year. It sort of feels that way. I can see our own volume picking up, our own backlog picking up. Certainly when it comes to the private equity community, they have to get back in the marketplace and return capital to their investors if they're going to continue to raise capital. And then I think with interest rates hopefully capping out, there'll be a lot more positive sentiment from the corporate and strategic buyers. Price is still an issue, and settling on price and what the right price is to clear the market has not been determined in my view, but hopefully that will be the case next year.
I'm curious, Marc, it's Julie here. If you feel like the deal activity is going to come from an offensive or a defensive position, the companies that you're talking to, how do they feel about sort of the economy more broadly and how that's going to drive their deal strategy?
So I think it's offensive, and that's what we're seeing. And we're seeing people use this as an opportunity to propel themselves forward. From the strategic standpoint, again, from the corporate perspective, it is a lot about how they position themselves over the next bunch of years to gain share, to be more profitable, to be more competitive. From a financial point of view, it really is more, or I should say from the financial buyer point of view, it's more of acquiescing to what is the current reality on pricing. When interest rates go up 500 basis points, multiples have to come down to a degree. And it's not a question of not having available financing. It's just a question of it just being more expensive. And at some point, multiples have to come down. And once that equilibrium is reached, once that understanding between buyer and seller is evident, then I think you'll see more transactions.
And Marc, you mentioned sort of these green shoots we're seeing here, some signs of rebound. What sectors, Marc, are you seeing there? Energy we discussed, but any others? Is it healthcare? Is it financial services? And where would you expect to see activity, into next year?
Well, if you don't see it in the biggest segments, you won't see major pickup in the overall M&A markets. And the two biggest segments by far are technology and healthcare. And they've been the two biggest segments that have seen drop-off over the past number of years. And so our expectation is those are the two segments that you will see a greater pickup. But I think it'll be across the board. Again, I think we have to focus on what's gone on over the past 18 months with interest rates going up so dramatically, so quickly, and it putting real pressure on again, what's the clearing price of assets? And now that's, I think, pretty clear that it's not going higher, and some would say it's going lower, but I'm not necessarily part of that camp. Then I think it should create that equilibrium that would drive activity. Because a big piece of this, the corporate market has been down. The M&A market, particularly the middle market M&A market, has been down far more dramatically, almost to the tune of 35 and 40%, and that's a big driver.
Marc, finally, I want to ask you about consumer-related companies in particular. Your firm has some expertise there within retail. You've done some deals more recently on that front. We got Target today, which, investors applauding the margins at the company. What are you hearing from that sector, especially as we go into the all-important holiday season?
It's all about consolidation, and it's a very difficult retail consumer marketplace, and to win, you need to consolidate. We're hearing about a lot of conversations going on. We saw earlier in the year with Coach and Michael Kors, but that's about positioning a company to be a player going forward, and realizing on the critical mass of a larger business and the savings and synergies that exist and the competitive advantages of larger groups, and no one needs it more than the retail and apparel world, and you're going to see more of that.
Marc Cooper, thank you so much for joining us today, Marc. Appreciate it.
My pleasure. Thank you.